Lesson 1. In this lesson, we'll take our first look at a chart and see how price is displayed. Now that we have our TradingView account set up, head on over to Search. Type in BTC USDT. Hover over the one that says Binance. This will show the price of Bitcoin in comparison to US dollars Tether, or USDT for short, on the Binance exchange. USDT is a cryptocurrency coin that represents $1 US. Click Launch Chart. This will launch the chart for Bitcoin USDT. The first thing we'll take a look at are the rectangular illustrations on the chart that show changes in price depending on the time frame. These are called candlesticks, or candles for short. Prices change depending on supply and demand. This is driven by emotions that investors have towards the value of a cryptocurrency. Very large increases in price, for example, mean that investors are anticipating the value of the asset will go up. We call this bullish. And large decreases in price generally mean that investors have an unfavorable outlook on the asset's price, expecting it to go down. We call this bearish. Candlesticks are important for traders because they help us visualize four key price points: the opening price, the closing price, the high price, and the low price within a specific time frame. The candlestick has a wide part called the body. The body represents the price range between the open and close of that time frame's trading. A green candle indicates that price closed above the open. A red candle means that price closed below the open. The projections above and below the body represent the highest and lowest price points that were reached in between the open and closing time frame. We call these wicks. There are many candlestick patterns to learn. However, it is only necessary to show the common ones so that we can get a general understanding. There are more patterns in the documents provided, which are just variations of what I'm going to show you. We will go more in depth on these patterns in a later video when we're analyzing a chart. The first candlestick pattern is the common engulfing pattern. The first candlestick in the image shows that sellers were in control, pushing the price below the open for a red close. The next candlestick, however, buyers, or bulls as we call them, took control and pushed the price up higher than the open on the previous candle, erasing the damage done by the sellers, or bears. The same happens in reverse, where the first candlestick is green and the second candlestick is red, erasing all the price change. The second candle engulfs the first. This is a good indication that either buyers or sellers are stepping in, and to pay attention for a change in momentum. The next candlestick pattern is called the doji. The dragonfly doji shows us that before the close, sellers were in control at first. However, as we approach the close, buyers stepped in and pushed the price up. Overall, there is little change in price. As we can see, the body is just a line. Then we have the gravestone doji, where buyers had control at first, but then the sellers came in towards the close and rejected the price downward. This indicates that the sellers now have more control. Dojis are common patterns that show buyers or sellers taking control on a single candlestick and that a change in momentum is likely. In the bottom left image, we have the hammer. This can be a normal hammer or inverted hammer, which has a long wick to the upside and a close in the green with a small body. This means that bulls are gaining more control than the bears. Conversely, we have the shooting star candlestick pattern. Similar to the hammer, the close for this candle is below the open, with a long wick upwards. This tells us how the bears have gained more control over the price, and is signaling a possible reversals to the downside. Lastly, the morning and evening star patterns. This is a common variation of the engulfing pattern, where the first candlestick is followed by another with a smaller body closing opposite, from red to green, or green to red. The third candlestick's body is larger than the first. Remember that this is an engulfing pattern, and it signifies that either the bulls or the bears have now taken control in the short term. This is a common reversal pattern that we'll see over and over again on the charts. Now that you have a general understanding of candlestick patterns, Let's take a look at how to track the momentum of the price. The momentum of price action is tracked by a trend. The concept of a trend is essential to technical analysis. The whole purpose of analyzing a chart is to spot an upcoming trend, so that we can ride it to a new price point and make profit. There are three major trends: the upward trend, downward trend, and sideways trend. In an upward trend, new highs rally successively higher than the previous, and new lows higher than previous lows. To track an upward trend, we draw a line connecting the lows. These points are called support. As long as the price stays above this line, the price is in an upward trend. We can add another line above to connect the highs of the trend. We call this the resistance. Together, these two lines create a trend channel, and is useful for traders to clarify in what direction the price is heading. Trends are likely to continue until some force acts upon it, kind of like Newton's first law of motion, where objects in motion stay in motion until a force acts upon it. Price tends to continue in its trend until its momentum weakens, and then a new trend can be formed. Downward trends can be tracked the same way, except this time both the new highs and lows are lower than the previous, as shown here. In a sideways trend, or range, price action stays within a definable range for some time, bouncing off of support and rejecting at resistance, until momentum takes the price in either direction above or below. Many retail traders find it challenging to win trades in a sideways market. However, it's quite simple to trade in once you understand how the price action behaves. I'll cover how to trade ranges in a later video. The last basic concept is volume. Volume is the total amount of trades that have taken place over a given time frame. We can see volume indicated by rectangles at the bottom of the chart that are colored green or red depending on if the price closed above or below the open. The larger the candle, the larger the volume. Now that we have an idea about candlesticks, price action, momentum, trends, support, and resistance, let's take a closer look at trends on a real chart. Now that you understand more about price action, trends, support, and resistance, we can get a better idea of what a given chart is telling us. Notice how price moves in waves, up and down repeatedly, making highs and lows. Remember what we have just seen in this lesson about trends. I want you to find a trend on this chart. Pause the video and look for highs and lows that follow a trend. Remember, this is a high, a low, a high, a low. Now, in order to track a trend, we use the trend line tool over here and click twice on the graph to make the line. So for an example of a trend, we can look right here. We have a series of higher lows, so we can connect the lines. They don't have to be exact, but they should be very close. So let's zoom in here. As you can see, we're making a one high, a higher high, and another higher high, a low, higher low again. But look at right here where we break support, which we marked with the trend line. Another thing I want you to pay attention to is look how price comes back right after. We call this testing. This is a bearish retest. And once there's a bearish retest, traders exit at a high price, and then the price shoots all the way down. And for another quick example, this time of a downtrend, we can see right here some lower highs. We can connect them all with a trend line, just like before. So now zooming in, we can see that the series of lower highs are touching the line. But notice once again, look at the break right here. Look what happened right after we broke out of the trend line. We resumed an uptrend. So the important takeaway here is that when you break a trend, you often make a new trend, whether it be going from an uptrend to a downtrend, or a downtrend to an uptrend, or to a sideways trend. So they're very important. The last trend that I want to show you briefly is the sideways trend. So we have one right here. We can see that price is bouncing around in a definable range from here to here, over and over again. So we can actually mark this with Alt H. So go ahead and click Alt and H. We can see that price hit this level here as support, moved up towards resistance, and then for this whole range, it just bounced up and down. Bounce off support, reject off resistance, so on and so forth. Now, what I want you to pay attention to is that when we broke out of this range, we came back and tested the previous resistance as support. And that's the important thing with trends, is that support becomes resistance and resistance becomes support when you break out of a trend and make a new one. So now that we have a better understanding of how the trends look like on the chart, we can get into more complex trends and patterns, and then eventually learn how to trade these trends optimally. With the understanding of what the 3 different trends look like on a real chart, let's look further into how they behave. We noticed that when the price broke out of the trends, that the price returned to the level of the breakout. The area of interest that was either support or resistance had switched roles. This is important to know because if you miss a breakout opportunity in either direction, you know that if you have enough patience, you'll see the price return to that level that the price broke out from. We call this a test or a retest. This is how you avoid feelings of FOMO, or fear of missing out, which often leads to traders entering a trade at the wrong time, just to see the price come right back down to where it broke out from, erasing any gains and even having less money than they started with. Other traders also trade on this idea of support and resistance switching roles. So after a breakout, there are many traders patiently waiting to buy at the same levels as you. This is why when price successfully retests that area of interest, it's common to see price move much further in the direction of the breakout. Patience in trading is key. As an example, here is AVAX in September of 2021. Where it says breakout, we have the resistance, which price broke out of. Now, it's very common and tempting to buy when the price gets higher, but now that you know how price returns to test the previous resistance as support, you know to wait. It turns out that buying right at the breakout was the perfect entry to ride the next wave up. You would have made 188% on this trade alone. If you were at 5x leverage, for example, you could have reaped in up to 941% profits. Although these breakouts often lead to successful retests and resume their trend, you must pay attention to the price to make sure it doesn't fall through and lose that support or resistance before making the trade. It is possible that price breaks through, however falls right back into the same range. We call this a fake out. How do we prevent ourselves from losing money that way? We use something called a stop loss. A stop loss will stop your trade if the price goes in the opposite direction to prevent any major losses. We'll explore the concept of fake outs and stop losses next so that we have a better understanding of how to enter and exit these trades. So we know about what trends look like and how to enter trades with them. But what do we do if the trend doesn't end up going the way we anticipate? Do we just jump right in because we see a breakout? The short answer is no. We have to practice risk management. It is essential to always have a plan for if the trade doesn't work out in our favor. Exchanges have a buy and sell feature called a stop loss or a stop limit order. This kind of order automatically exits your trade at a certain price point to prevent any major losses. We call these price points invalidations because they invalidate our trading thesis. On your crypto exchange, the option will be among the buy and sell orders dropdown. As we learn about different trade setups, we will discuss where to place our stop losses so that we don't ever lose any large sums of money. There are many times where we see a breakout happening on a chart. However, they surprise us by heading in the complete opposite direction shortly after. Sound familiar? This is called a fake out, or when it comes to trading ranges, we call it a deviation. Fake outs and deviations happen everywhere, all the time. To spot a fake out, first, we look at the volume. Is the volume increasing as the trend is breaking out over multiple candle closes? Next, we wait for the third candle to close outside of the zone to confirm that we are heading in that direction. As we can see here in the summer of 2021, Bitcoin had 2 deviations, which trapped most traders. However, it was pretty easy to avoid getting trapped by looking at what we just went over. The volume on the breakout candle had not increased. In fact, the volume was the same on both fake outs. The third candles outside of the range closed back inside the range. This is because a small amount of very wealthy market manipulators are pushing up the price. We call them whales. Market manipulators have the capital to move markets, but can't affect the volume as much on their own, so they leave clues behind the mind games that they play. With these criteria mentioned about breakouts, you could have avoided getting trapped, or took it a step further and shorted or longed in the opposite direction for profit. Finally, on the third breakout here, the third candle closed above the range with increasing volume, which meets our criteria to take the trade. As with every trade, we place our stop loss. Here we could have placed it 1 to 3% below the entry point. By successfully applying this strategy, you would have gained a great return. Remember, knowledge is money, and patience is key. You're starting to see how understanding how the market works can make you a lot of money. When a trend is broken, we call its move in the opposite direction a retracement. If the prior trend is to continue, retracements often reach halfway through the previous move. For example, if a cryptocurrency went up from $100 to $200, it is quite common to see retracements back to $150. However, this depends on market sentiment. Common retracement percentages are 32%, 50%, and 62%. If the entire move is retraced, this is simply a downtrend that must be traded accordingly. On trading platforms, there is a tool that plots an image on the chart that measures these values automatically. It is called the Fibonacci retracement tool. It will be useful to track where a cryptocurrency could bounce and reverse its course. However, in our trading strategies, we're going to use these levels to add more onto our trades. To demonstrate retracements and the Fibonacci retracement tool, we're going to take a look at the ETH chart on TradingView. On the left, click on the third icon and click Fibonacci retracement. To measure a move in an uptrend, we first click on the swing low and the swing high of the move. It'll be right here, but I'll just extend it out here so that we can see it more clearly. So as you can see in this uptrend, it retraced no further than the 62% level. If it were to penetrate that level, we could see in the next move over here that it would just be the signal of a continued downtrend, and in that case we would have to trade it accordingly. Now let's remove that one off of the chart and look at another example. Let's look at Ethereum as of the move starting around mid-June. So again, click on the Fibonacci retracement tool, click on the swing low, all the way to the swing high, and let's have a look. So as you can see in this retracement, the 50% level is 1484, which is almost exactly where it retraced, and it's possible that ETH continues its uptrend. So we look at the 50% retracement level as a common point of retracement where you could add on to your longs so that you can make more money in the uptrend.